Hi, everybody. It's Three Things to Know with JM Partners. This week, we're talking about anticipating home prices and mortgage rates. And Stephen Thomas with Sanctuary Mortgage is with us to share a little bit about that. Stephen, thanks for coming.
Hey, Jerry. Thank you for having me. Pleasure to be here.
So, three things to know. You have got always, everybody. Stephen has the best insights on the market and on mortgage rates, and bringing that together for buyers, sellers, real estate agents, and your clients is always enlightening. So we couldn't not have you. You've been on once before, but we could not have you back on.
Thanks, Jay. My goal is to keep it simple.
Let's see if we can do that. So three things to know this week. We're going to talk about supply and demand, what that means for home prices, go from that to what's really the current state and health of the market, because that's relevant. And last but not least, so now what about mortgage rates and how do we predict and anticipate what they might be? So number one, tell us a little bit about supply and demand and all the insight you've got.
Sure. So Jere and I were talking before, and one of the second most question that I get asked from buyers is, what do I think is going to happen with the real estate market? Do I think that really they're fishing? They're fishing to see if I'm going to tell them that homes are overvalued and going to go down. That's what I think is happening. And the truth is, I do not think that home prices are going to go down. I don't think that home prices are overvalued. And again, with the model of the idea of keeping it simple and supply and demand, that's the basis of the economy, the supply and demand. So we're going to look at supply. Supply in the housing market is really, really low. We're at less than a 2-month supply. And what's driving that? It's new construction. When we look at historical new construction volume for the 4 decades prior to 2010, we built 25 to 26 million homes per year or per decade as a country. So 25 to 26 million homes per decade as a country. Then let's fast forward to the most recent decade, which was 2010 to 2020. As a country, we only built 5 to 6 million homes. So we haven't built enough homes today to put it into the marketplace for people to buy. So there's your supply. On the flip side of the basics of economics is demand. So what does demand in the marketplace look like today? You have the largest demographic, the largest generation of people, which is millennials, entering into and becoming the ages and going through the life events that people want to buy homes. So millennials are starting to get married, they're starting to have kids, and that's when they want to buy homes. So we've got a low supply, and then we've got a super strong demand of people that want to buy homes. And therefore, I don't see any devaluation of homes.
So basically, you've got in the last 40 years, 50 years ago until 10 years ago, 100 million homes. And then in the last 10 years, you've got 5 million, a little more homes being built. Yep. And now we've got more buyers coming into the market with the millennials than ever before. So that's prices exactly right. Have already gone up, and we're talking about supply and demand. I've heard people say it's going to be 10 years for that supply to balance out with what the incoming demand is, and it's going to be.
Yep, it's definitely going to take a couple of years for builders and building volume to catch up to support the amount of people that want to buy homes today.
So that leads us into number 2. Yeah, sure, that's what we say, but can people really buy a house? I mean, look at what happened in 2007. We thought the market was great and everything turned upside down and the mortgage industry almost imploded, or kind of did. So how do we know that something like that's not happening again?
Yeah, so I think a lot of people, we've had some economic volatility over the last year, and a lot of people I've said, well, I'm going to sit on the sidelines until this all just kind of blows up, and I'm going to swoop in and get the deal. And I don't see that happening because the market is very, very healthy today. And what do I mean by healthy beyond the points that we just talked about? For one, 2008, 2009, the mortgage industry was basically giving a loan to anybody that would fog a mirror. So, lending guidelines definitely got more to where they should be after that. We have ability to repay, which requires that a lender prove someone can repay the loan that they're getting. And we have requirement of down payments. So we're not writing loans that really shouldn't be written. And then on top of that, back then, you could buy a home and not put any money down. And then after you closed, go get another loan on top of it to go buy 2 new cars. So people end up owing much more on their houses than they were worth. So when the economy went through some struggles, it wasn't worth it to stay because they didn't have any equity in their house. Where, okay, again, let's fast forward and let's look at today. People have the most equity in their homes today than they ever have had in history. So there's much more drive or purpose for somebody to really, try to make their payments, do everything they can and not walk away. So that's really a factor that I say we have a very, very healthy real estate market.
Well, we always say on this show, we've been saying like this is an inverse of the last recession. For example, the one that makes the most sense to me is I remember back in 2007, I owned a house and I thought, gosh, I made like a down payment. I actually made a down payment. And this house is still costing me per month twice what it would if I were just renting it. In today's market, we're doing down payments. We've got equity, but on top of that, the cost to own a home is so much less than it would be if you were renting it and you've got no control of what those rental payments are going to do. So you look at the market in general, it just makes more sense to own, which reinforces what you said, the health of the market.
Yep. Big advantage, purpose of buying a house is that it fixes your home costs, whereas renting typically increases, 5-10% every single year. When you buy a house, you're not going to have those increases because you've locked in. Hopefully you're doing a fixed rate mortgage with today's low rates. And so you've kind of fixed that housing cost.
Which is also like huge. I mean, oh, by the way. So last but not least, now let's get supply and demand show clearly demand is staying high and it's only going to increase and supply is as low as it's ever been. So that being said, now we're looking at the health of the market. Mortgages are strong. It makes sense to buy a house. The market's strong in real estate. Oh, I'm not speaking to the rest of the market. I don't know. I'm real estate what anyway. But last but not least, okay, great. So it sounds like we should buy. Now's a good time to sell or buy or both. But what about like mortgage rates? What are they doing? It always sounds like it's like day trading, but what is it really? And how do we anticipate? How do we read it? How do we know when to get the loan, lock the loan, all that stuff?
Yeah, so you mentioned that, today the cost of home ownership is much less than renting. Well, one of the big things driving that is the historically low interest rates that we've seen in the marketplace over the last 18 months. So how long are we going to have these rates? I don't know. I don't have a crystal ball. If I did, that'd be great. I would love to tell everybody. But we can use history again to help us predict the future. And now the Fed has said that they don't have any intentions of raising their Fed funds rate for any time soon, so that will help keep rates low. But there's some other factors that the market is keeping their eye on. And those two factors are inflation, what's happening with inflation data. And then the second one is what is happening with the Fed's bond buying policy. So right now, the Fed has a monetary policy, where they're buying a lot of bonds to help bring demand into that bond market. And the market has expected that they will taper back, they will scale back the amount of bonds that they are buying. And when they do that, when they make that announcement, rates will move up quickly. Now that may seem drastic when I say rates will move up quickly. So let's talk about, what does that mean? I don't mean that rates are going to go from 3%, where they are at the time of this recording, to 5% overnight. I do not expect that. I think a more realistic expectation, in my opinion, is maybe they'll go up 0.3%, maybe they'll go up 0.5% over the course of a month. So looking again at the huge, the big picture. Let's not stay here. Let's look at the big picture. We're at 3, maybe rates go to 3.5. That's still absolutely outstanding when we look at, the historical rate graph. If I showed it to you, 3.5 is still absolutely amazing.
Yeah, it's kind of low. It's kind of amazing. I remember that my first house I bought a long time ago was at 7%. And I remember talking to my family and my dad said, you'll never see interest rates this low again.
Yeah.
We're half that now. It's crazy.
Yeah.
Awesome.
So all in all, I mean, I think that it's a great time to buy a house. Sure, inventory's low, but you're able to get in. I think the market is set to appreciate. Do I think appreciation will be as drastic as it has been recently? No, but I still think the market will appreciate. I think that overall, the market is in a very healthy place. And then, I mean, over the long term, locking in a low rate is going to save a ton of money if somebody's going to stay there, especially long term, 30 plus years.
So let's sum it up. 3 things to know about anticipating home prices and mortgage rates. Number 1, look at supply and demand. It's pretty clear. Supply is incredibly low. Demand is incredibly high. So prices are going to continue to rise. We don't think at this rate, but they're going to continue to rise. Number 2, how do we know the health of the market is strong, equity strong, it makes sense to buy a house financially? And then last but not least, we look at mortgage rates and anticipating the mortgage rates and what the bond market is doing. Mortgage rates may go up, but if they go up, it's going to be 0.25%, and that's still going to be incredibly, at least for a good while to come, incredibly competitive rates. And I'll add one last thing to that as the real estate agent. In this market, when you're deciding what to do, the key is just knowing what's important to you and the moving factors. If it makes sense to move, then you make the move. When you look at the inventory, you have the broker that pinpoints the house for you, and inventory becomes a lot less relevant because the focus is the house that you want to buy. Just know all of these things about the market to make the right decisions.
That's exactly right. And put yourself prepared for success.
Love it. Stephen, thank you so much for coming back on the show. Everybody, Stephen Thomas, Sanctuary Mortgage, and we'll talk to you again really soon.
Thank you for having me, Jere.
Thanks. And three things to know.jmpartners.io for all of our episodes and to keep up with the market in Atlanta every week. Bye.
Have a great day.
You too.
Thank you for listening to the JM Partners Atlanta Market Eavesdrop. If you like what you heard, please subscribe and share with your friends who might be moving or who just want to keep up with the latest on the Atlanta residential market. You can find us anytime online at jmpartners.io. That's jmpartners.io.